Priced for a global monopoly. Its filing says foreclosed from China. Priced in? So here's the puzzle. The market pays about $5 trillion for Nvidia, at roughly 31 times earnings and 20 times sales, with a Wall Street buy rating and an average price target near $318, about 50% above where the stock actually trades. That is a price that treats the market for AI compute as global, durable, and already won. And remember what's underneath that price. Nearly 90% of Nvidia's revenue is data center chips, the precise product these export roles govern. So, this is not a side exposure. It is the core of the machine. And yet, Nvidia's own annual report says, in its own words, that it is effectively foreclosed from competing in China's data center market. Now, the stock is more than 10% below its 52-week high of $236, but that is not the business breaking. Revenue grew 85% last quarter. The stock still trades well above its 200-day average. Margins are intact. For the full year, it grew revenue 65% to $216 billion. The dip is a change in the multiple, not a change in the machine. So the question isn't whether Nvidia is a good business. Plainly it is. The question is narrower and stranger. A single policy switch already flipped that China line off once. So what is a revenue line the price treats as a solve footnote actually worth, when the switch can flip again in either direction? Reason 1. This already cost real money. It isn't a scenario. On April 9, 2025, the United States government informed Nvidia that it would now need a license to export its H200 chip, the one part it had purpose-built for China, into that market. The consequence hit the very next filing. In the first quarter of fiscal 2026, Nvidia took a $4.5 billion charge for H200 inventory and purchase commitments it could suddenly no longer sell. To put the size in view, H200 sales had been about $4.6 billion in that single quarter before the rule, and Nvidia said it could not ship another $2.5 billion it had lined up. You can see the scar with no interpretation needed. That quarter's gross margin collapsed to 60.5%. The quarters on either side of it ran about 73%. 73.0 the quarter before, 72.4 the quarter after. Strip the one-time charge out and the margin was roughly 71. So a single government letter turned finished inventory into a write-off inside 90 days. Now, be precise about what happened, because this is where most coverage overreaches. The rule did not delete Nvidia or zero out China forever. It restricted the channel, and then months later, licensed a sliver of it back. That distinction matters for everything that follows. And this was not the first turn of that screw. In 2022, Washington restricted the A100 and the H100, and Nvidia answered with China-specific parts, the A800 and the H800. In 2023, the rules widened to capture those two, which is how the H200 came to exist at all. Each workaround bought about a year, but the core point stands on the tape. The export control switch is not a hypothetical risk sitting in a footnote. It has already printed a dollar figure and left a visible dent in the margin line. Reason 2. Watch the fingerprint on the top line, not just the P&L. Nvidia reports revenue by where its customers are headquartered, and it recasts those figures onto a single consistent basis. So we can finally track China cleanly. 2 years ago, China was about 20.2% of sales. A year later, 19.2%. Then, this past fiscal year, 9.1%. It roughly halved in a single year. And here is the part that actually strengthens the bear case. This is not just a shrinking slice of a bigger pie. The absolute dollars fell too. China revenue dropped from $25 billion to $19.7 billion, a $5.4 billion decline. In the very same year, the whole company added more than $85 billion of new revenue. Every other part of the map went up. China went down in dollars, not just in share. In the most recent quarter, it was down to 5.6%. One honest caveat a sharp viewer will demand. This figure is by customer headquarters, which Nvidia itself says is not the same as where the chips are ultimately used. So treat it as a rough proxy for China exposure, not a precise meter. But the direction is unambiguous, and it is the company's own account. Export controls biting the mix. And note the timing. The sharpest drop landed in the year after the license rule, which is exactly what you'd expect if policy, not demand, were driving it. The permanent global market the price assumes has a country-shaped notch cut out of it, and over the last year, that notch got wider. Reason 3. Even the reopening is a toll road with no cars on it. Here's the part the bullish tape skips over. The door did crack open. In January 2026, the Commerce Department moved the successor chip, the H200, from near automatic denial to case-by-case approval. Read that carefully. That is a loosening, not a crackdown. But look at the terms bolted onto it. Every H200 bound for China must first pass a physical inspection inside the United States, and then pay a 25% tariff when it is imported into the US. A tariff Nvidia says it may not be able to pass on to customers. That is one toll, and it is specific to this chip. Separately, and this is a different thing, US officials have voiced an expectation, uncodified, never published as an actual rule, that the government will take 15% or more of the revenue from licensed sales off the top. So that is a second, more informal toll. And the outcome so far? By Nvidia's own filing, $0 of revenue booked under the H200 China program. In July 2026 congressional testimony, not a filing, so treat it as reported. Commerce described the shipments as trivial, despite roughly $10 billion in approved licenses. Put it together, a mandatory inspection, plus a chip-specific import tariff, plus an off-the-top revenue expectation, all layered on a line that is still generating nothing, and that still needs Beijing to say yes. Think of it as a pipe with a valve at each end. Washington holds one, Beijing holds the other. Washington has now loosened its valve, and the flow is still zero, because the other one has not turned. It is a toll booth on an empty road. The reopening looks generous on paper, and delivers nothing on the tape. Now, the strongest honest counter, and it is genuinely strong. So let's give it full weight. First, the market already watched this happen in real time. China's share roughly halved, and over the same stretch, Nvidia grew net income to $120 billion, more than doubled its US revenue, and drove the stock right back up to near its 52-week high. The thesis that China matters to the P&L was put on trial, and the tape returned a verdict of no. Nvidia is worth more today than it was the day the China rule landed. Second, you cannot lose what nobody counted. Nvidia books zero H200 China revenue today, so the forward estimates the price rests on already carry essentially nothing for China. A further clampdown subtracts from a number that is already zero. Third, supply is fungible. Nvidia is sold out. Demand exceeds everything it can build. Every chip it does not ship to China gets reallocated to capacity-starved Western hyperscalers at full margin. A lost China unit changes the shipping label, not the revenue. And that 15% expectation? 85% of some new China revenue still beats 100% of nothing. Fourth, the direction of travel is actually toward loosening. A hard ban, then H20 licenses, then H200 case by case. On this reading, the export control story is a resolved footnote, already absorbed, and the multiple already reflects it. And the multiple is not even demanding. On next year's earnings, Nvidia trades around 16 to 17 times, with a price-to-growth ratio well under 1. If the business is compounding at this rate, and China is free optionality on top, the bear is arguing with a stock that already priced the bad news and moved on. But history says this instrument does not always reverse. In 2019, Huawei was placed on the entity list under a presumption of denial, and years later, it is still there. Some restrictions get traded away, others harden into permanent architecture. Nothing in the record yet tells us which one this is. Here's where the counter-argument cracks. The conventional view is that China is already priced as zero, so there's no downside left. Contrary to that, look at the same desks. Many of those sell-side analysts are also carrying a China recovery, numbers in the $15 to $20 billion range, as upside in their bull scenarios. Notice what that means. It is not that one side is right and the other wrong. It is that the same revenue line is being carried at roughly zero in the base case and as live upside in the bull case, at the same time. That is not a settled footnote. That is a line that is unpriced in both directions, and a line that can be marked up can also be marked back down. So the risk didn't disappear. It just went quiet. But here is the deeper structure, the part that actually makes this a keeper. This revenue line was switched off by one government, and it can only be switched back on by two. Nvidia's own filing is explicit. To return, it needs a product that wins the approval of both the United States government and the Chinese government. The gate is bilateral. On the US side, reporting suggests the rules kept tightening even into 2026. A subsidiary loophole closed, and the top Blackwell chips still banned outright for China. On the China side, back in 2025, Beijing's own cyberspace regulator reportedly told ByteDance, Alibaba, and Tencent to stop buying, and that status may well have moved since, so it's one to recheck before you lean on it. Either way, the point holds. The US loosening is necessary, but it is not sufficient. This is a double veto lock, not the one-way ratchet that both the bull and the bear quietly assume. One government can switch it off. So, back to the question we opened with. Is the export control exposure priced in? The honest answer is, not yes. And it is not this crashes. It is open. And there is a precise thing to watch that settles it. The price and the sell side disagree by something like $15 to $20 billion over a line that is running at zero today. The tell is not the tariff and not the 15% cut. The tell is a single number, whether H200 China revenue moves off zero at all. Watch the August 26th earnings print. If that number breaks above zero and starts climbing toward the recovery pace the bulls are modeling, then the upside is real, and the whole toll structure, the tariff, the inspection, the 15% expectation, becomes the live story. If it stays trivial, as Commerce testified this July, then that recovery is a model, not a cash flow, and the roughly 9% in shrinking China share keeps decaying. We have seen this shape before. In 2018, a single US order cut a Chinese company called ZTE off from American parts and nearly liquidated it within weeks, until a political deal switched it back on. Corporate access as a switch, flipped by governments, not by demand. That is a precedent for the shape of the risk, never a price call. Two last notes. These figures come from Nvidia's own filings and government sources. The read on what they mean is AI-assisted, educational, and not advice. And one caution for the bulls who call this stock cheap. That 32 times multiple is flattered by a one-time $16 billion gain that did not come from selling chips. Strip it out, and you are closer to 35 times for a company that still has a policy switched hole in its map, and two governments holding the keys.